All right, welcome to Talk Tickers. So, DLF just dropped their Q1 numbers for fiscal 26, and wow, what a quarter. We're talking monster sales, cash flow just pouring in, and yet the stock dropped. It makes no sense on the surface, right? That's the paradox we're going to unpack today. We'll get into what the market is seeing, or maybe what it's missing, what the game plan is for management, and what this all could mean for the stock. Okay, so here's the plan. We'll start with that paradox I just mentioned. Then we'll peel back the layers and look at the numbers. After that, it's all about management's long-term strategy, what's coming up in the pipeline, and then, you know it, we'll wrap it all up with our final rating. Let's do this. So, first up, the earnings paradox. You know, every earnings report has a narrative, but this one from DLF, it's a real head-scratcher. You've got this incredible performance on one hand, but the market's reaction was, well, not great. So what's going on? What are investors picking up on that seems to fly in the face of all the good news? And really, it all comes down to this one question. Record-breaking sales, but the stock takes a hit? How does that happen? What's the actual story here? To get to the bottom of it, we've got to line up the pros and the cons. And here you have it, the two sides of the story in black and white. On the positive side, I mean, you can't argue with these numbers. Revenue absolutely crushed what analysts were expecting. Pre-sales went through the roof, a new record. And they even paid down a good chunk of debt. That's the bull case. But then you look at the other side, a miss on GAAP earnings per share, a reported gross margin that, frankly, spooked some people. And the result? The stock dropped right after the call. That's the conflict we need to solve. Okay, so let's dig in a little deeper, get behind those headlines. And let's start with the good stuff, the numbers that had everyone so excited initially. First, let's talk revenue. Just look at this. The street was looking for something like 1,900 crore. DLF comes in and posts over 2,700 crore. That's, what, a 43% beat? That's not just a beat, that's a knockout. It tells you that demand for what they're selling is just incredibly strong right now. And check this out. The engine that fuels all that future revenue, we're talking pre-sales here, it was just on another level. Over 11,400 crore. That's up a staggering 78% year over year. Think of that as guaranteed money just waiting to be recognized. And it's all coming from these super successful launches, like the Privana projects and their big Mumbai development. Okay, but this is where things get tricky. This is the number that pumped the brakes on all that excitement. The GAAP earnings per share, or EPS. It came in at 3 rupees and 8 paise. The consensus was expecting 353. So that's a miss of almost 13%. And for a lot of the market, the folks who are laser focused on that bottom line number, this was a big flashing red light. And, well, the market's reaction was pretty swift and pretty clear. The stock closed down over 2% the day after the earnings came out, and it was on heavy trading volume too. So it's obvious, right? Despite all that amazing top-line momentum, that earnings miss was what really mattered, at least in the immediate aftermath. So to really make sense of this disconnect, we have to change our perspective. We need to stop looking at it like a day trader and start looking at it through the eyes of DLF's management. Because you see, their long-term strategy tells a completely different story. And you don't even have to guess. They said it loud and clear on the earnings call. Ashok Toggi basically said, look, we're not just chasing big, flashy pre-sales numbers. Our main goal is to strengthen our margins, boost our cash flow, and, this is the big one, grow our rental business. And that brings us to this really important idea they kept talking about, embedded margin. What is that? Well, think of it like this. It's the profit that's already baked into the sales they just made. They won't recognize it on the income statement today, but it's coming. And for this quarter, that number was a really healthy 40%. So management's argument is, hey, don't look at the 28% reported margin. That was just because of a weird mix of projects this quarter. Look at the 40% we've locked in for the future. That's the real measure of our profitability. So how does this all fit together? Well, they have this strategy they call their flywheel. It's pretty smart, actually. Step 1, you launch these huge, successful development projects like Privana. Step 2, that generates a ton of operating cash flow. Step 3, and this is the crucial part, instead of just pocketing that cash, they plow it into expanding their annuity business. Think office buildings, retail malls. And step 4, that creates a growing stream of stable, recurring rental income. It's a self-funding machine that makes the whole business stronger and more predictable. And they are not kidding around about this. They are putting their money where their mouth is. We're talking about 5,000 crore in planned capital expenditures just this year to build out these rent-bearing assets. And then another 5,000 crore planned for next year. That's a massive commitment to this rental strategy. Okay, so a ton of money is being spent. Where is it all going? let's take a look at the actual project pipeline that's going to drive all this future growth. And wow, the rest of fiscal 26 is just jam-packed. You can see the momentum building. In Q2, they've got office rentals starting to kick in. That ramps up even more in Q3. But the real kicker is Q4. They're expecting to get the first rental income from three new malls. And all this is happening right as they're targeting the formal launch of their next big thing, the Dahlias project. It's a lot happening at once. Let's zoom in on those 3 new malls for a second. We've got one in Moti Nagar, one in DLF Phase 5, and one down in Goa. This isn't a small addition. This is a major expansion of their retail rental portfolio. All of them are expected to start bringing in rent by the fourth quarter, which means we'll see them contributing to the top line in early 2026. This is exactly that stable, recurring revenue they keep talking about. And while all this rental expansion is happening, don't forget about the other side of the business, the development engine that's paying for everything. That flywheel is still spinning. Dahlias is already about half sold, and they're getting higher prices even before the formal launch. Their Mumbai project, Phase 1, completely sold out with Phase 2 in the works. Plus, they've got another residential launch planned for Goa, so the pipeline for cash generation is still looking very, very strong. Okay, so we've seen the whole picture now, right? The short-term earnings miss that spooked the market, but also this really compelling long-term strategy and a pipeline that's ready to deliver. So it's time to put it all together. It's time for the next call. How should you be thinking about this stock today? So here's the big question. Do you bet on the long-term vision, this plan to build a rental empire, or do you worry about the short-term margin pressures that clearly made investors nervous? Which story wins out? All right, here's our rating. We're calling it market perform, and here's why. The long-term story here is fantastic. I mean, this shift to a development plus annuity model, it's the right move. It's smart, and it's how you build real sustainable value. But you can't ignore the present. The market is clearly focused on margins right now, and there is real execution risk here. They've got to actually build and lease up all these new assets successfully. So for now, we see a pretty balanced risk-to-reward profile. So for our final segment, the next call, here's a trade idea to think about. We're calling it the rental re-rating arbitrage. The whole thesis is that the market is looking at DLF through the wrong lens. It's still pricing it like a cyclical boom-and-bust property developer. But under the hood, it's transforming into a steady, high-quality rental company, almost like a REIT. So the pitch? As all these new malls and offices come online and start printing cash over the next, say, year and a half, the market might wake up and realize what DLF has become. And that could cause its valuation to re-rate much, much higher, closing the gap with what those pure-play commercial asset owners trade for. It's a bet on that perception gap narrowing over time. And of course, we've got to say it, this is just our analysis, it's for informational purposes, and it is definitely not financial advice. You should always do your own homework before making any investment decisions. Thanks for tuning in to Talk Tickers.